How are we doing? Cyber world? Stephen Palmieri coming to you here. Multi-stream and coming to you today. And we are going to talk about your finances. I think that's the only thing that I know how to talk about. And that's why you guys follow me. So today we're going to talk about how the wealthy use debt in order to generate cash flow and to avoid taxes. My name is Stephen Palmieri, for those of you guys who do not know me, and my team and I help individuals, small businesses just like you, raise your credit scores, pay less in taxes, and improve your accounting processes. And feel free to chat in your comments below, and we're going to go ahead and just jump right in. And if you guys have questions, let me know. So how do the wealthy generate cash flow or capital without paying taxes? This is not one of those speeches on, how the rich avoid taxes. Everybody needs to pay their fair share. There are strategies, but this isn't really about that. But what we're going to talk about is what creates a taxable event. Okay, so let's suppose that you have $100,000 in stocks, or you have, that's an asset, right? That is a thing of value on your books. That's $100,000. Let's say that's the current value. Or let's say you own a property for $100,000, right? Again, that's something we can all understand. Property, real estate, something like that. Well, if you sell that stock or you sell that property, what happens? You've sold it and you've basically made income. And for the purposes, for this, we're assuming the property at hand is not your primary residence. It's an investment property. On the tax code, basically for your primary residence, if you're married filing joint, you have $500,000 of appreciation that you don't pay taxes on. If you're single, $250,000. So for most folks, they usually don't break those caps when they sell their personal property. But so for the sake, let's talk investment property. You've got a $100,000 lot sitting somewhere because you probably don't have a full-on property for $100,000. I mean, I guess you could. You put that on the market, you sell it. Of course, you've got what you paid for it, your basis. You paid $50,000, you sell it for $100,000. Now you've got a $50,000 profit, which you're going to have to pay taxes on. Similar thing with the example. Let's say you have $100,000 in stock. Let's just say Microsoft stock. Well, Microsoft's not cool these days. Let's say Tesla stock. All right. So you have $100,000 in Tesla stock, which probably is like 2 shares or something like that. Of course, you're going to have your basis in that as well because you purchased it for a certain value. Let's say $50,000, and now it's worth $100,000, and you sell it. So your original cost was $50,000. You made an extra $50,000 on it. That's profit. You're going to have to pay taxes on that, or at least I should say that creates a taxable event without going into minutiae if you've got losses and other ways to offset that. But that creates a taxable event. It makes sense, right? You've got something, you bought it for this price. You're going to sell it for that price. You're making a profit. Well, there is another option that should be available to you and is available certainly to the wealthy. And if it's not available to you, that's why you need to know, because it's probably not available to you because the banks don't like you, because you probably have credit problems. But those are just temporary issues to work through. We can help you with that. But once you get to where you're credit worthy, okay, you should be able to borrow against assets. Okay, I mean, and again, we're talking typically like if you're running a business, but I mean, certainly just as an individual consumer, you can try to get a personal loan backed by something, of course. But we're talking, hey, if you're in a business game, you're really in the game of trying to build a machine that's going to generate you wealth, generate you cash flow. On the one hand, you've got your $100,000 of Tesla stock and you can sell it, or you have your $100,000 property value real estate and you can sell it. Or on the other hand, assuming you're credit worthy, you can go to the bank or a lender, we should say, because sometimes the banks don't, they're not really necessarily they don't have the appetite for certain types of funding. But you can go to a lender is the point, pledge these assets as collateral and walk out of there with a loan against your collateral. Now, you're probably not going to get 100 cents on the dollar. That's fair to say. They're probably not going to give you $100,000 backed by your $100,000 of Tesla stock. They're probably not going to give you your $100,000 back to your $100,000 of the property value. That's not really the point either, right? You guys get the point. The point is how can you work wiser, smarter with the tools that you have? So let's say you are able to walk out with $60,000 or $70,000. That's still a win, given that you did not have to sell your asset. So when you borrow money from a lender, whether it's a bank or any other creditor, that's irrelevant. That's now debt. Okay, so if you were to walk out of the bank with $100,000 on a loan, that does not go as profit on your P&L. Okay, it's important to understand that. Some folks may think, oh, well, I've got $100,000 in my pocket, that's profit. And that goes into the whole accounting world and understanding how it works. But just because you have money that's given to you from somebody, it's not necessarily profit, right? In this case, it's debt. Yes, you've got, let's say, $100,000. Okay, we'll just keep the numbers even. You've got your $100,000 loan, you've got your $100,000 in cash, but it's not profit. You didn't sell a product or a good for that. In fact, you are now indebted to the lender, right? So it's debt money, and that is not a taxable event. Now, of course, you're going to have your interest, and your finance charges to pay there. But again, assuming that you're a business or, you're operating as a small business, that interest that you pay on this would be typically a business expense, something that you deduct from your actual profit that you make from selling products. So, if you kind of look at it as from a business decision, on the one hand, you sell assets and it creates a taxable event. You no longer have those assets, but you do have the cash. On the other hand, you're able to get financing from somewhere, borrow tax-free money at the expense of the cost of interest. Okay. But that interest then actually reduces your profit from your business. Which one of those makes more sense? I can't sit here and tell you, which one makes more sense for you based on your situation. But what I can do is sit here and share this information with you. So the takeaway here is, if you've got assets and if you're able to borrow against those, there's a whole lot of ifs going on there and a whole lot of qualifiers. But if you've got assets, if you're able to borrow against those assets, that's not a taxable event. It actually, interest you would pay would be a business expense or business deduction, reducing your profitability. For a lot of business-minded folks, building the machine, that makes sense to do. Okay. Whereas if you go and you sell your stock, you sell your real estate, you sell your whatever, there is a taxable event there. You've got your cash burning a hole in your pocket. It is your cash. You do not owe anybody else, but you will owe the IRS. Theoretically, it's a taxable event. That being said, I wanted to bring this information to you guys, and I appreciate you all following me. And if you've got questions when you're watching this replay, chat them below and tag me. If you like what you hear, message me, DM me. Would love to talk with you. Again, my name is Stephen Palmieri, and my team and I, we help folks just like you raise your credit scores, pay less in taxes, and improve your accounting processes. And remember, fix your finances and improve your life. I will see all of you on the next show. You all take care.